All right, welcome back to SIE Mastery. So in our last session, we really nailed down the key players, right? We talked about the issuers, the investors, and those all-important broker-dealers in the middle. And we mastered that critical distinction. A broker is an agent, a dealer is a principal. Now we're going to take that framework and follow the money. We're going to track the flow of capital itself, from the very beginning all the way to the open market. Let's get into it. So let's just start with a really powerful question, one that just cuts through all the noise. Where is a stock actually born? I mean, where does it come from? The answer to this is the key. It's what unlocks the entire structure of the financial markets because it forces us to see the huge difference between creating a security and just trading one that already exists. Okay, and to make this really stick, we are not, I repeat, not going to memorize a bunch of dry definitions. No way. Instead, we're going to build a powerful mental model. Think of a giant river system. The primary market? That's the headwaters. It's the source, right up in the mountains, where new securities are born. And the secondary market? Well, that's the huge flowing river downstream, where all those existing securities are traded back and forth between investors. Now look, this isn't just some cute analogy. This framework is literally how you're going to navigate these concepts intuitively when you're under pressure in the exam. So here's our game plan. First, we'll define these two great rivers of capital. Then, we'll dive into the primary market and the crucial role of the underwriter. After that, we'll head downstream to the secondary market to see what it does. And finally, we'll map out all the different places where trading happens. Simple as that.
All right, Section 1, Capital's two great rivers. Look, if there's one distinction the exam will test you on again and again, it's creation versus trading. Let's lock this in right now.
Okay, let's head up to the source, the headwaters. Section 2, the primary market. I want you to think of this as the factory floor. This is where new securities are literally built from scratch to raise fresh capital for the very first time. And pay close attention to the direction of the flow here. It's a one-way street. In the primary market, the money flows from the investor directly to the company or the government body issuing the security. This is not investors trading with each other. Nope. This is the company itself getting that cash to build new factories, to expand, to create something new.
And look, this isn't some abstract, theoretical thing. You see this stuff in the news all the time. The big one, of course, is the initial public offering, the IPO, right? That's when a private company first sells shares to the public. But it's also when an existing public company decides to sell more shares, or when a corporation issues new bonds to build a new headquarters. Heck, it's even when your local town sells municipal bonds to raise money for a new school.
The Google IPO is the perfect example. Think about it. All those billions of dollars that were raised, they didn't go to a bunch of traders in New York. No, that cash went straight into Google's bank account, into their treasury, to fund their incredible growth. That is the absolute heart of the primary market. The issuer gets the money. End of story. So, how does a company like Google actually pull this off? How do they connect with millions of potential investors all over the world? I mean, they don't just throw up a web page and say, hey, buy our stock, right? This brings us to the real machinery of the primary market, the critical role of the underwriter. You can think of them as the investment banks that build the bridge, connecting the company that needs cash to the investors who have it. Okay, now there are two main ways they build this bridge, and you absolutely have to know the difference. The exam will hit you with this from every angle. First up is called a firm commitment. In this case, the underwriter is acting as a dealer. What does that mean? It means they buy the entire stock offering from the company, putting it right into their own inventory. They own it now. All the risk, it's on them. If they can't sell the shares to the public, that's their problem, not the company's. The company gets paid, guaranteed. Now the second type is completely different. It's called best efforts. And here, the underwriter acts as a broker, an agent. They don't buy a single share. They just promise to use their best efforts to help the company sell the stock. And for that, they get a commission. See the difference? They take on absolutely zero risk. If the shares don't sell, well, that's still the company's problem. Okay, stop. This is a critical point. Don't try to memorize these as two separate random facts. That's a trap. Instead, I want you to see the single beautiful pattern that connects them. Look here. Firm commitment means they act as a dealer, taking on risk as a principal. Best efforts means they act as a broker, working as an agent. Wait a second. That's the exact same broker-dealer distinction we already mastered. It's the same pattern, just in a new suit. Seeing this, recognizing these underlying structures, that is how you dominate this exam. All right, so we're leaving the headwaters now and we're heading downstream into the main river.
Section 4, the secondary market. This is that huge flowing marketplace where existing securities get resold. And here's the most important thing to get. No new money is being created for the company. The original issuer gets absolutely nothing from all this trading.
So you might be asking, well, if the company isn't getting any money, what's the point of all this? The answer is one word, and it is everything: liquidity. That's it. It's the ability for an investor to turn their investment back into cash quickly and easily. Think about it. Without a healthy secondary market, the primary market just wouldn't work. I mean, who in their right mind would buy a brand new stock if they knew they could never, ever sell it?
Let's make this crystal clear. Let's say you go and buy 100 shares of Apple stock on the NASDAQ. How much of your money does Apple, the company, get from that trade? The answer is a big, fat zero. Nothing. Zilch. You bought those shares from another investor, not from Apple. The money just moved from one investor's account to another's.
Okay, so this brings up the next obvious question, which leads us to our final section: mapping the trading venues. I mean, it's one thing to say investors trade with other investors, but where? Where does all this trading actually happen? Let's lay out the entire map.
So the secondary market isn't just one building in New York. It's really a network of 4 distinct types of venues. And once you understand the job of each one, you'll have a complete map of how everything fits together.
First up, you've got the ones everybody's heard of, the exchanges. You know, the New York Stock Exchange, the NASDAQ. Think of these as centralized, official marketplaces. They're highly regulated, they have super strict rules about which companies can even get listed, and trading is very transparent and orderly. It's all about structure and rules.
Okay, next, and this is the polar opposite, you have the over-the-counter market, or OTC. The keyword here is decentralized. There's no physical building, no trading floor. It's just a huge electronic network of dealers trading directly with each other. This is typically where you find stocks of smaller companies, the ones that don't meet those super strict listing rules for the big exchanges. All right, now here's where things can get a little tricky for some people, but it's really simple when you see the logic. The third market, this is where exchange-listed stocks, your Apples and your Googles, are traded off the exchange over in the OTC network. And you might ask, why would they do that? Well, it's mostly for huge institutional investors who need to buy or sell massive blocks of stock. Doing it this way helps them avoid causing a huge price spike or crash on the main exchange. And last but not least, we have the fourth market. The easiest way to think about this? It's the wholesale club of the financial world, like Costco for stocks. This is where massive institutions, pension funds, mutual funds, trade directly with other massive institutions. They completely bypass the brokers to cut down on costs. This is the deep end of the pool, where the biggest of the big players operate.
Okay, let's pull it all together. What are the absolute critical takeaways? Number 1, the primary market is the factory. It creates new securities and the money goes to the issuer. Number 2, the secondary market is the resale shop. It doesn't create anything, but it provides that all-important liquidity for investors. And number 3, and this is key, those underwriting roles, firm commitment, and best efforts, they aren't new ideas. They're just another application of that fundamental dealer versus broker pattern. So there you have it. You now have the complete mental model for how capital flows through the entire system. Your next step for locking this in, for achieving true mastery, is to open up the SIE Mastery System book. Focus on chapters 3.2 and 3.4. But don't just passively read. I want you to actively connect every single concept, every trading venue, every underwriting type, back to those core broker-dealer roles we covered. Build that web of connections in your mind. That is how you take control of this material. So we've mapped the entire river system, and we've followed the money from the source all the way downstream. But that begs a question. With all this power and money flowing around, what keeps the river from flooding its banks and causing chaos? Well, next time, we're going to dive into the rules of the river, the critical regulations that shape and control every single transaction we just talked about.